Now, that's where the answer can become tricky because interest rates change. And so, if we were to rewind, let's say like 10, 15 years ago, you could probably get 3% by putting money into a savings account. Rewind another 25 years, maybe you could have gotten 4 or 5%. You fast forward to today, you're lucky to get 1%. And you're probably having to switch to a no name broker to do that. Today, though, because interest rates are so low, all of the yields that go along with interest rates, it's all pegged together. And so to get a guaranteed yield between 3 to 5%, I don't think that's the right mindset to have. Wanting to have a guaranteed 3 to 5% isn't really the best thing to necessarily go for. I think it's really going to depend on, what's the time horizon. So like I said, for me, my time horizon's 20 plus years. I go into the stock market, I'm looking for 10% return, give or take, per year. A yield of 3 to 5%, if you were to do that in like a dividend stock, you might end up in a stock that's kind of more risky, and that's why it has that higher yield. And you could even argue with that with bonds today too. So I would say that at today's interest rates, you probably won't get a low risk for 3 to 5%. You'll probably take on some medium risk. And so the question needs to become, well, what's the time horizon? Because is it worth my time horizon? If it's like 10 years away, then maybe it's worth taking an extra risk and trying to chase that 3 to 5%. But, if your time horizon is like 5 years away and you need this money to retire, I don't see any reason to get a higher risk than something very low risk. In that case, I don't think 3 to 5% is realistic. And that's why I would say shooting for that particular yield percentage is not a good strategy because it all depends on time.
I echo a lot of what you're saying. I think those are great ways to think about it. Let's look at a couple other things to kind of put it in perspective to kind of, I guess, frame what Andrew was talking about. The 30-year yield on a treasury bond right now, which is arguably one of the safer investments you could do out there, is hovering around 2%. I believe it's between 2.02% and 1.98% over the last few days. So, and the only reason I know that is because I've been doing some DCFs lately. So, and that's what I use for my terminal rate. And those are not as high as what you're looking for, but they're certainly more than you're getting in your savings account. So that is a reference point as something that could possibly give you a better return. That is certainly a safe investment. But to realize that, you're going to have to put that money away for 30 years. And is that really what you want to do? So I guess there's that question. So then there's another idea to think about is if you wanted to invest in bonds, in corporate bonds, something that Andrew mentioned, there is the opportunity to invest in the only two companies that offer triple A rated bonds, which are the safest bonds that you could possibly buy on a corporate level, are Microsoft and the Johnson and Johnson. And while Andrew was talking about this, I looked up Microsoft's latest bond yield for the latest bond issuing they did in 2017 is 3.3%, and that's for a 30-year bond. So it's better than the Treasury yield, but you're still tying up your money for 30 years to get that 3%, 3.3%. So again, certainly safer than investing in, you pick any stock. I don't, it doesn't matter. You pick something a little more
Visa.
exotic. Yeah, there you go. Visa. You pick, well, maybe not Visa, but you kind of get what I'm saying. So picking a stock is going to have a little more risk, but it's certainly going to have way more yield than something like the Microsoft bond would have. So then I thought about, okay, what about something like Johnson and Johnson, which has a AAA rated bond, but it also pays a dividend. It's a dividend aristocrat. It's been paying a dividend for 50 some years, and it's been paying a growing dividend for 50 some years. So you could argue that's a pretty safe company to invest in. They pay a dividend right now with a yield of about 2.5%, give or take. And so that's less than what Jay is looking for. But you would have the capital appreciation of the share return earning, hopefully, better than 2.5% over a period of time. So that could be a possibility. But investing in stocks is no guarantee. So there are no easy answers to this question. And like Andrew said, there's a lot to unpack here. But I think really you need to think about several things. And kind of, I guess, to just kind of keep beating the table that Andrew was talking about, you have to think about your time horizon. That really has to be the first thing you have to consider, because that really goes into forming the decision that you're going to make about what kinds of things you want to invest in. The longer time horizon you have, the more ability you have to overcome any drawdowns that may happen. Because believe it or not, for those of you younger that are listening to our show, the stock market does not always go up to the right. Unfortunately, there are times when it goes down, or things don't, or they just kind of fluctuate around kind of blah for a while. But there's also long periods of time where it goes up and does great, like it is right now. And if you invest in something and you have a 40-year time horizon, you have time to recover if things go poorly with, if you buy Johnson and Johnson today and 4 years from now the stock drops 20%, you have another 36 years for it to recover, and it will. And so that is what you have the advantage of. Now, if your time horizon is 5 years, then the options become a lot more complicated, because now you have to think about how much risk am I willing to take for that yield that Jay is asking for. And if I have a 5-year time horizon and I want that kind of yield, frankly, you're going to have to step into more risk to get that. And so that's why it makes it hard to answer this question, because we don't really know what the time horizon is. And that really has a huge bearing on what kind of decision you make, whether you invest in things like bonds or keep it in a money market account, or whether you want to go with corporate bonds or treasury bonds. There's some advantages to buying some of those things, because they'll give you close to some of those yields you're looking for, but you're also sacrificing some of the gains that you could get by buying Microsoft or Johnson and Johnson or Apple or any of those other choices that are arguably pretty safe investments, but they're still going to have volatility to them. And so those are things you just have to consider when you're doing all these things. And it really comes down to what your time horizon is and how much risk you can stand and how much risk you can stomach. And I think one of the things that maybe we don't talk enough about is kind of the idea of risk. And when you think about risk, you have to think about how much could you be willing to risk losing. And it's not about the stock price going down, because like Andrew was saying, if you got a 40-year time horizon and Microsoft loses value in the next couple of years, you have 38 years for that to recover, and it will. And even if the market goes sideways for a few years, you're still going to do well, because the company is a great company and it's going to continue to do well at what it does. But if you're buying something that's a lot riskier, or it's in an industry or a sector that is very speculative at best, there's a chance the company could go bankrupt and then you lose all your money. And so that's rare, but it's something you have to consider. And so that's really what you have to balance, is how much can I handle a drawdown or a loss in price of the stock for a period of time, or how much am I willing to gamble on whether the company will go bankrupt or not. And that's, I guess, something I would consider as well.
That's a great way to outlay it. We talk about a lot time horizons and how that ties into risk. And you might wonder, why do I come up with this random number, 20-year time horizon?
Sure.
If you look back at the data, I mean, we have data up on the stock market all the way back to like the 1800s, basically. I mean, maybe 1910s, but the stock market's been around since the 1800s. So there are cycles in the stock market, just like the seasons. The stock market kind of can look like a roller coaster in the short term, but it's like a roller coaster that's pointed to the moon eventually if you look long enough. But in between that path to the moon, there's this roller coaster up and down. And so we can observe what's happened over decades and decades and decades. And so if you look back, you look at any 5-year period, when you get in and when you get out, it's pretty random. And so even a 10-year period, there are times where you would buy and 10 years later you could be even or you could be down. But once you get to 15 years and once you get to 20 years, go ahead, look back at the history of the stock market and crunch some of those numbers. You'll see that you'll make money anyway, regardless of where you buy in, if you have that 15 to 20 plus time horizon. And so I think when you talk about, Jay talks about what's the percentage of money and he's starting to slowly put more into the stock market. I think it's a great idea to like increase that percentage over time. And if you have money that you think you'll need, that you can't just leave in the stock market to let it grow and compound and let it be volatile and move up and down. If you have some money like that, well, then you can just keep that kind of safer in something really low risk or even in cash. And the rest of it to grow and to do what it does well in the stock market. That's where all these ideas come from. It's not like these magical numbers pulled out of the air. It's based on history, and if you take the time to learn about how the market works, you can increase your chances of getting better returns and at lower risks. But I think you have to switch away from the mindset to say, I'm going to earn this much. And you really have to look, what's my reality? What's reasonable? And what are the investment options out there?